Ladies and gentlemen, Mr. AG here, and I need you to stop whatever you are doing right now because what just happened in the silver market is not normal. This is not a routine price increase. This is not a gradual trend continuation. This is a violent, explosive, record-shattering move that signals something fundamental has broken in the global financial system. Silver just smashed through its all-time high and is trading near 100 and now to over 35 per ounce. Let me repeat that number so it burns into your memory. $109.35 per troy ounce of silver. This is the highest price in the entire recorded history of this metal. Higher than the Hunt brothers squeeze in 1980. Higher than the 2011 peak. Higher than anything anyone alive today has ever witnessed. And that is not even the most important part of this story. The most important part is what caused this move. The most important part is how fast it happened. And the most important part is what it tells us about where this market is heading next. Before I dive into the details, I need to make something absolutely clear. I will never ask you for money. I will never pitch you on some investment fund. I will never run paid signals or managed accounts. I will never tell you to send me your capital. Your money is yours. Your decisions are yours. Your responsibility is yours. And if anyone ever uses my name or this channel to solicit your investment, they are a scammer, and you should report them immediately. Protect yourself. Protect your family. Stay far away from anyone promising guaranteed returns in this space. Now let me walk you through exactly what happened and why this moment will be remembered as a turning point in financial history. Silver is up 5% in a single day. Think about that. A 5% move in a single trading session for a major precious metal is not supposed to happen. These are supposed to be stable, liquid markets with deep order books and institutional market makers smoothing out volatility. A 5% daily move is what you see in penny stocks and meme coins, not in a metal that has been money for 5,000 years. But it gets more extreme. Silver is up nearly 50% in the past month alone, 50% in 30 days. That is not a rally. That is a repricing event. That is the market telling you that the previous price was wrong, that supply and demand have fundamentally disconnected, and that a new equilibrium is being discovered in real time. And the year-over-year numbers are even more staggering. Silver has gained 259% compared to this time last year. 259%. That outpaces even gold's impressive rally. That outpaces the S&P 500, that outpaces Bitcoin, that outpaces virtually every major asset class on the planet. And yet, when you turn on the mainstream financial news, what do they talk about? They talk about AI stocks. They talk about the latest Fed meeting. They talk about everything except the precious metals market that is screaming a warning signal about the stability of the global monetary system. Ask yourself why that is. Ask yourself who benefits from keeping your attention away from silver and gold. Connect the dots with me for a second. At the heart of this silver explosion are President Trump is aggressive tariff announcements that have rattled global markets in ways we have not seen since the trade wars of his first term. But this time, the stakes are even higher. Trump has threatened 100% tariffs on Canada if they proceed with a trade deal with China. 100%. That is not a negotiating tactic. That is economic warfare. And Canada is not just any trading partner. Canada is one of the largest sources of silver production in North America. Canadian mines supply a significant portion of the silver that flows into American industrial supply chains. If those supply chains get disrupted, if tariffs make Canadian silver prohibitively expensive, where does American industry turn? The solar panel manufacturers, the electronics companies, the electric vehicle producers, where do they source their silver? That is the question the market is asking right now, and the answer is reflected in the price. But Trump's tariff threats do not stop at Canada. He has announced tariffs on 8 European nations, including France, Germany, and the United Kingdom. The reason? Their opposition to U.S. plans regarding Greenland. That is right, Greenland. The massive Arctic territory that happens to sit on enormous deposits of rare earth minerals and strategic resources. This is not just about trade. This is about resource control. This is about which nations will dominate the supply chains of the 21st century economy. And when the world's largest economy starts picking fights with its closest allies over Arctic resources, investors get nervous. They start looking for safe havens. They start looking for assets that cannot be printed, cannot be sanctioned, and cannot be defaulted on. They start looking for silver and gold. And that is exactly what we are seeing in the data. The surge in silver prices reflects a dramatic escalation in safe haven demand. Investors are fleeing paper assets and piling into precious metals because they understand that the global financial system is entering a period of unprecedented stress. Gold has hit records above $5,000 per ounce. $5,000 for a single ounce of gold. That number would have seemed like science fiction just a few years ago. Now it is reality. Now it is the price that millions of buyers around the world are willing to pay for the security of holding real money. And silver, as the more volatile and more affordable precious metal, is experiencing an even more dramatic move. When gold rallies, silver tends to outperform because it is a smaller market. The same buying pressure that moves gold a few percentage points can move silver by double digits. That is exactly what we are witnessing. Let me take you deeper into the mechanics of why this move is happening, because understanding the structure tells you whether this is sustainable or just another flash spike that will reverse. A historic short squeeze is amplifying this move. Traders who were betting against silver, who were short the metal expecting prices to fall, have been caught completely wrong-footed. They are now scrambling to cover their positions, to buy back the contracts they sold, and that buying pressure is accelerating the rally. This is how short squeezes work. When price rises, short sellers face margin calls. They have to either put up more capital or close their positions. When they close their positions, they have to buy. When they buy, price rises further. When price rises further, more shorts get squeezed. It becomes a self-reinforcing cycle that can push prices far beyond what fundamentals alone would justify. But here is what makes this squeeze different from previous spikes. The fundamentals today are stronger than they have ever been. In 1980, when the Hunt brothers tried to corner the silver market, they were essentially alone. They were identifiable. They were targetable. The exchanges changed the rules mid-game, raised margin requirements specifically to crush their position, and the price collapsed. In 2011, when silver hit $49, the rally was driven largely by speculation and quantitative easing. When the European debt crisis stabilized and central banks signaled they had things under control, the momentum faded and price corrected for years. But today the buying is not coming from a single identifiable source that regulators can target. Today, the buying is coming from everywhere. Retail buyers in China and India are surging into physical silver. They are buying 1 kilogram bars because smaller denominations are sold out. They are paying premiums over spot price because dealers cannot source enough metal to meet demand. They are converting their savings into tangible assets because they do not trust their own currencies or their own governments. Sovereign entities are accumulating precious metals at the fastest pace in decades. Central banks that used to mock gold as a barbarous relic are now buying tonnage every month. They understand what is coming, even if they cannot say it publicly. Industrial users are panic buying because their supply chains are at risk. Solar panel manufacturers need silver. Electric vehicle producers need silver. Electronics companies need silver. 5G infrastructure needs silver. Defense contractors need silver. And the supply is not growing fast enough to meet the demand. The Silver Institute's data shows annual deficits where demand exceeds supply by roughly 100 million ounces. That deficit has to be filled from above-ground stockpiles, and those stockpiles are running dangerously low. This is not speculative froth. This is structural shortage meeting unprecedented demand, meeting geopolitical chaos. Now, let me connect another critical dot that the mainstream media is barely mentioning. China has been systematically restricting exports of critical materials for months. They have implemented controls on antimony. They have curtailed exports of gallium and germanium. They have made clear that strategic minerals essential to modern technology will be prioritized for domestic use. And there have been ongoing discussions about potential silver export restrictions. Think about that for a moment. China is both a major producer and the world's largest consumer of silver. If they decide to limit exports, if they decide to stockpile domestically, the rest of the world faces an immediate supply crisis. You cannot build solar panels without silver. You cannot build electric vehicles without silver. You cannot build the semiconductors that power everything from phones to missiles without silver. This is not an optional input. This is an essential element in the technologies that define modern civilization. And China knows this. They know that controlling the supply of critical minerals gives them leverage in any trade negotiation, in any geopolitical conflict, in any economic war. So when Trump threatens tariffs on Canada and Europe, when he picks fights over Greenland's resources, he is playing a high-stakes game where the other side holds cards that most Americans do not even know exist. Peter Schiff, the veteran investor who has been warning about dollar collapse for years, put it perfectly. He said, and I quote, "Silver and platinum are finally catching up to gold." Investors avoided buying those metals as they expected gold to fall. They've now accepted that gold's rally is here to stay. That is a profound shift in market psychology. For years, silver underperformed gold because investors kept expecting the precious metals rally to end. They kept expecting interest rates to normalize. They kept expecting the Fed to get inflation under control. They kept expecting the system to stabilize. They were wrong. And now they are capitulating. They are accepting that the monetary debasement is permanent. They are accepting that deficits will continue to spiral. They are accepting that the purchasing power of their currency will continue to erode. And they are rotating into hard assets as fast as they can. That is what a 259% year-over-year gain looks like. That is what the death of a narrative looks like. That is what happens when millions of investors simultaneously realize they were sold a lie. Let me give you the dollar picture because nothing happens in isolation. The US dollar has been weakening, influenced by Federal Reserve rate cut expectations. When the Fed signals that it will ease monetary policy, it makes dollar-denominated assets less attractive to international holders. They can get better yields elsewhere. They can find currencies that are not being actively debased by their central banks. A softer dollar makes commodities priced in dollars more attractive. It takes fewer euros, fewer yen, fewer yuan to buy an ounce of silver. That stimulates international demand. That brings in buyers from around the world who see silver as cheap relative to their own currency. And right now, expectations for Fed rate cuts are rising because the economic data is weakening. Despite all the talk of soft landings and resilient consumers, the cracks are showing. Manufacturing is contracting. Consumer credit is stretched. And delinquencies are rising. The labor market is cooling. The Fed will have to choose between fighting inflation and preventing recession. And if history is any guide, they will choose to print. They will choose to cut rates. They will choose to debase the currency rather than allow a deflationary collapse. And when they make that choice, where do you want your savings? In paper dollars that are being printed by the trillions, or in silver and gold that cannot be printed by anyone? The market is giving you its answer in real time. Now let me give you the bearish case because I refuse to give you one-sided analysis. I refuse to be another voice pumping hopium without acknowledging the risks. If you are going to make decisions with your capital, you deserve the full picture. First risk, overbought exhaustion. Silver has moved too far too fast by any technical measure. The relative strength index is deep in overbought territory. Momentum indicators are stretched to extremes. When this happens, even in strong bull markets, you often see corrections. You see profit taking. You see weak hands shaking out before the trend resumes. A pullback of 10%, 15%, even 20% would be completely normal within the context of a secular bull market. If you're not prepared for that volatility, you will panic, sell at the worst possible time. Second risk, intervention. When silver threatened to break out in previous cycles, the powers that be intervened. Margin requirements were raised, rules were changed, media narratives about bubble risk were amplified. Regulators stepped in to cool the market. Could that happen again? Absolutely. When concentrated short positions held by major bullion banks get threatened, those banks have tools to fight back. They can coordinate selling. They can lean on exchanges to raise margins. They can plant stories about irrational exuberance and bubble conditions. We saw this playbook in 2011. Multiple margin hikes in a matter of weeks forced leveraged longs to liquidate, and the price collapsed from 49 to eventually below 15. That could happen again. Anyone who tells you otherwise is not being honest with you. Third risk, liquidity crisis. If we get a broad market deleveraging event, a credit crunch, a sudden risk-off move across all asset classes, silver will get hit in the initial panic. March 2020 proved this. Silver fell from 18 to 12 in 2 weeks because leverage players were forced to sell anything with liquidity to meet margin calls. In a true liquidity event, correlations go to 1 and everything gets sold except cash and government bonds. It does not matter if the fundamentals are bullish. It does not matter if silver is the most undervalued asset on the planet. When forced selling hits, price drops. Fourth risk, geopolitical de-escalation. If Trump suddenly backs off on tariffs, if trade tensions ease, if a diplomatic solution emerges, the safe haven bid that is driving silver could evaporate. Risk appetite could return. Money could flow back into stocks and bonds. Precious metals could correct as the crisis premium gets unwound. But here is what those bearish scenarios do not change. The structural deficit in silver supply is real and ongoing. Every year, more ounces are consumed than are produced. The shortfall has to come from somewhere, and above-ground inventories are not infinite. The industrial demand is not going away. Solar installations are not going to stop. Electric vehicles are not going to disappear. Electronics manufacturing is not going to reverse. The demand drivers are structural, not cyclical. The monetary debasement is not going to stop. Governments around the world are running deficits they can never repay through taxation. The only way out is inflation. The only way out is printing. And when you print currency, hard assets go up in nominal terms. The geopolitical fragmentation is not going to stop. We are not going back to the unipolar world of American hegemony, where trade flowed freely and everyone played by the same rules. We are entering a multipolar world where nations compete for resources, where supply chains get weaponized, and where strategic materials become leverage in economic warfare. These forces are not temporary. They are not going to reverse because of one Fed meeting or one trade deal. They are the defining characteristics of the decade ahead. Let me tell you what one major Wall Street bank got completely wrong and why it matters. City analysts updated their outlook and set a price target of $100 by April. They thought they were being bullish. They thought they were ahead of the curve. They thought $100 silver was an aggressive forecast. Silver blew through $100 and never looked back. It is now trading near $110, and Citi's price target is already obsolete before the month they targeted even arrived. This tells you something important about how the establishment thinks about precious metals. They are always behind. They are always underestimating. They are always revising their models after the market has already moved. When Citi says $100 and the market says $109, who do you believe? The analysts sitting in air-conditioned offices running spreadsheets? Or the millions of buyers around the world who are actually putting capital to work? The market is the ultimate truth teller. Price is the ultimate information aggregator. And price is telling you that the demand for silver is far stronger than any Wall Street model predicted. On social media, traders are posting in real time about silver breaking $109. They are talking about banks caught in major precious metals shorts. They are talking about dollar erosion. They are speculating about whether Europe, China, and Japan will increase their dumping of treasury bonds. This is the conversation happening outside the mainstream financial media. This is what millions of people are seeing and discussing while CNBC talks about the latest quarterly earnings from some tech company. The information asymmetry is breaking down. People are waking up, and they are acting on what they see. Let me give you the levels that matter going forward, because this is where analysis meets action. Analysts are forecasting silver to trade in a range between $90 and $120 for the year. That is a wide range, and it reflects the uncertainty about how this situation resolves. But even the low end of that range, $90, is higher than silver traded for most of the past decade. The psychological resistance at $110 is the immediate level to watch. Round numbers attract sellers. Options dealers hedge around these levels. A clean break above $110 with volume confirmation would signal that the trend is accelerating and that higher targets are in play. Above $110, there is not much historical resistance because we are in uncharted territory. The previous all-time high from 1980, adjusted for inflation, would be well above current levels. Some analysts argue silver should be trading at $300 or higher in real terms, based on historical ratios to gold and to money supply. On the downside, support sits at previous resistance levels that have now become floors. The $100 level is psychological support. Below that, the $90 to $95 zone represents the consolidation range from earlier in the rally. And below that, deeper support comes in around $80, where buyers stepped in aggressively in previous corrections. But here's the key insight. In a trending market, corrections are buying opportunities, not sell signals. As long as the fundamental drivers remain intact, pullbacks are when you add to positions, not when you panic and liquidate. Let me reframe what is happening here, because I think most people are missing the bigger picture. This is not just a silver rally. This is a vote of no confidence in the global monetary system. This is millions of people around the world looking at their governments, their central banks, their currencies, and saying, no thank you. This is capital fleeing from paper promises into tangible assets that have held value for millennia. When silver goes up 259% in a year while stock markets struggle to make new highs, the market is telling you something. It is telling you that the old playbook does not work anymore. It is telling you that the 60-40 portfolio is not going to protect you. It is telling you that the next decade will look nothing like the last decade. The people who understand this are positioning accordingly. They are accumulating physical metal. They are buying mining stocks that are leveraged to the silver price. They are reducing their exposure to financial assets that depend on the system remaining stable. And the people who do not understand this, they are still chasing AI stocks and meme coins, still believing the Fed has everything under control, still trusting that their pension will be there when they retire. One group is going to be right. One group is going to be wrong. The market will decide. Now let me give you the supply and demand dynamics that underpin everything else, because this is where the fundamentals really shine. Global silver supply is struggling to keep pace with demand. Mine production has been essentially flat for years, while demand has been growing. The deficit has to be filled from above-ground stockpiles, recycling, and inventory drawdowns, and those sources are finite. Industrial demand is projected to hit records. Solar panel installations are growing exponentially. Electric vehicle production is ramping up. A 5G infrastructure is being built out globally. Every single one of these applications requires silver in significant quantities. And on the supply side, new mine development takes years. You cannot just flip a switch and produce more silver. Permitting, construction, and ramp up take the better part of a decade. Even if silver prices doubled tomorrow, it would take years for new supply to come online. This is what a structural supply deficit looks like. Demand grows, supply stays flat. Price has to rise to balance the market. And when price rises, it attracts even more investment demand, which makes the deficit worse in the short term. It is a setup that can lead to exponential price moves when the breaking point is reached. And based on what we are seeing in the market, we may be at that breaking point right now. Here is what the physical market is telling us. Premiums on physical silver coins and bars remain elevated. Dealers are struggling to source material. Lead times for orders are extended. In Asia, buyers are shifting to larger 1 kilogram bars because smaller denominations are sold out. This is not what you see in a market with abundant supply. This is what you see in a market that is tight and getting tighter. The paper price and the physical price are diverging. And when that divergence becomes unsustainable, the paper market has to catch up to physical reality. That is what repricing looks like. That is what happens when decades of paper manipulation finally meet real-world supply constraints. The price does not adjust gradually. It gaps. It spikes. It moves in ways that break models and blow up short positions. We are watching this happen in real time. Let me leave you with a historical context that puts everything in perspective. Every major currency debasement in history has led to a repricing of precious metals. Rome, Weimar Germany, Zimbabwe, Venezuela. When governments print money to cover their debts, when they inflate away their obligations, hard assets rise in nominal terms. The United States is running deficits north of $2 trillion per year. The national debt has crossed $36 trillion. The interest payments on that debt are now larger than the defense budget. There is no mathematical path to paying this back through growth and taxation. The only path is inflation. The only path is debasement. And when you understand that, you understand why silver at $109 is not the end of the move. It is not even the middle. It is the early stages of a repricing that has to happen, because the math demands it. The question is not whether precious metals will continue to rise in nominal terms. The question is how fast and how far. And based on the accelerating pace of government borrowing, the intensifying geopolitical tensions, and the structural supply deficits in physical silver, the answer is probably faster and further than most people expect. 3 key takeaways from everything I have shared with you today. Number 1, silver hitting $109.35 is not just a price milestone. It is a signal that the global monetary system is under unprecedented stress. The combination of tariff threats, geopolitical tensions, currency debasement, and physical supply constraints has created a perfect storm for precious metals. This is not speculation. This is capital seeking safety. Number 2, the risks are real, and you must be prepared for volatility. Overbought conditions, potential intervention, and liquidity events can all cause sharp corrections, even within a secular bull market. If you cannot stomach a 20% drawdown, you should not be in this market. Manage your position size accordingly. Never invest more than you can afford to lose. And never use leverage you do not fully understand. Number 3, the fundamental drivers are not temporary. Industrial demand is growing. Mine supply is flat. Government deficits are spiraling. Geopolitical tensions are intensifying. These forces will be with us for years, not months. The trend is your friend until it ends, and there's no evidence that this trend is anywhere close to ending. Here is the unresolved tension I am leaving you with today. We do not know how far this rally goes before correction. We do not know if $110 holds, or if we see $120 or $150 first. We do not know how governments and central banks will respond to precious metals threatening their monetary credibility. We do not know if the short squeeze intensifies or if the shorts find a way to regroup. What we do know is that the price action is confirming everything the precious metals community has been saying for years. The manipulation is failing, the physical market is tightening, the paper promises are being exposed, and millions of people around the world are waking up to the reality that their currencies are being debased. This is not the time for complacency. This is not the time to assume the trend will continue forever without any setbacks. But it is also not the time to dismiss what is happening as irrational exuberance or bubble behavior. The market is telling you something. Price is truth. And the truth right now is that silver is more valuable today than it has ever been in recorded history. So verify what I have told you. Check the price data yourself, read the analyst reports, track the industrial demand numbers, follow the geopolitical developments, look at the deficit spending, look at the debt levels, look at the physical premiums, and make your decisions based on evidence, not emotion, based on logic, not hype, based on your own research, not anyone else's opinion, including mine. This is your capital. This is your future. This is your responsibility. I'm not here to tell you what to do. I am here to give you the information you need to make your own informed decisions. What you do with that information is entirely up to you. This is Mr. AG. Stay sharp. Stay informed. Stay skeptical of anyone who promises you easy money or guaranteed returns. And I will see you in the next one.